All right, well, welcome everybody to the September session of the Roundtable for September 2016. We're welcoming all knights and damsels. Kim Butcher is joining us here tonight, coming back with another repeat selection of Novo Nordisk. Also joined by Ken Kabula, Hugh McManus, and my name is Mark Robertson. And if you have any questions or want to follow up on anything, you can use my email address there, markr@manifestinvesting.com. And then we also have Natalie Kabula serves as a reminder. She sends out reminder emails. She's not going to inundate you with emails, but does send out some reminders. And if you or a friend want to be reminded, nkabula1@comcast.net. So let's go ahead and get underway. Here's the standard disclaimer. Again, everything that we do here is an educational demonstration. No investment recommendation is intended. We use real stocks in real time, but for illustrative purposes that are intended to demonstrate the philosophies and methods of the National Association of Investors and Better Investing, and as interpreted by Manifest Investing. So again, we may talk about stocks that we own, we may own them, and the important message is that everything we do here is literally a demonstration. Here's our standing agenda. Again, welcome if you're joining us for one of the first times. For those of you that are return guests at the meeting, welcome back. We'll take a look at our results over the last 6 years briefly. We're going to continue the discussion just a little bit on the better selling. I think we're going to hit it a little bit harder next month. We've got a very full agenda. As you can see there's 4 stock presentations to be made. NBO by Kim. Ken Kabula is going to do Mednax. I'll take a look at Norwegian cruise. That's not simply because I was influenced by the recent Puget Sound cruise to Alaska. That did actually just end up at the top of some screening results. Hugh's going to go ahead and share Bristol-Myers Squibb. He threatened to do that last month. We'll do an audience poll, and then we do try to, although we try to keep the meeting at about 70 to 75 minutes, we do leave it open for questions and answers afterwards. Here's a quick reminder of what we're doing. We're just here to share ideas. Our ideas with the community. We do keep track of the stuff that we bring before you every month. We've been doing this now for six years, so that's pretty close to 70 months of ideas that have been shared. We keep tracking the tracking portfolio, and we hope that the ideas that we share over time will beat the market as measured by the Wilshire 5000 by 5 percentage points over the long term. And we do like to see more selections outperform the stock market than fail to outperform the market. Here's a look at our current situation. Our rate of return over that, again, roughly 6+ something year period is 11.6%, beating the market by about 2.5 percentage points. Again, that's 250 basis points as shown there. The trend is good. We continue to get stronger results as time goes by. Over half of our selections have outperformed the market from the time of the decisions made, the selections, and fairly decent performance over the long term. Our long-term objective, again, is inspired by the Modern Investment Club movement. It's represented by that dotted red line. We'd like to beat the market by 5 percentage points, but again, we also acknowledge the fact that it's extremely rare that that happens. You can look at all kinds of institutional portfolios. Very rarely will you see an institutional portfolio hit that 5% level. Again, anything in that 2, 3, 4% range is exceptional. And most institutional portfolios end up in the -2 to -3% range, so that literally is our objective, to aim for that and hope for the best. Any comments or questions on that, Ken?
No, except that I'm glad to see that our outperformance accuracy has risen above 50% now. That's always a good sign. That means that more than half of the stocks we chose are in that outperform the market scenario, and that's just a really heartening thing to know that we're doing a better than dartboard chance, and since I would guess in the stock market it's not a 50-50 blend between outperform and underperform, we probably are doing better than a dartboard would do.
Mm-hmm. When we look at the Motley Fool, for example, does their CAPS program at Fool.com, the number is closer to 35 or 40% for outperformance accuracy. Now, some of the people who do very well do get up in the 60, 80, 90% range. Some even a little bit higher than that. But again, the average result is down around 35 or 40%. So you're right, Ken. It's a jungle out there for most average investors, especially when they're chasing hot stock tips. Let's go ahead and press on. Let's take a quick look at the companies that have the largest influence on the tracking portfolio. And now these are the top 20. Some of these have been chosen multiple times. For example, Cognizant Technology has been chosen 12 times. Every time it's chosen, we invest $1,000 into it, whether it's picked by a guest damsel or one of the knights or the audience. Whenever that vote is made or selection is made, we put $1,000 into it. So $12,000 invested into Cognizant has become $16,800. You can actually go and look at a legend at that public link at the top of the page. You can see every selection that's ever been made that is currently still active in the portfolio, and see how many times. There's a legend right there that tells you how many. For example, Apple, I believe, has been selected 8 times. 8 times has become $12,590 in the case of Apple. So from top to bottom, there's some household names. There's some names on there that are a little bit more obscure. The ones with asterisks are companies that are not in the Value Line 1700 Standard Edition. So you see that down the page at NIC, that's ticker symbol EGOV, E-G-O-V. And then a little bit further down, netease.com, ticker symbol NTES. And I know that's a favorite holding of Ken. Did you want to say a few words about NetEase and how kind it's been to you, Ken?
NetEase is one of the largest holdings in one of our model investment clubs. We've purchased it, I don't know, maybe 8.5, 9 years ago. It's a Chinese gaming company. They license games from throughout the world, and then people subscribe to those games through the company. They also have original games. What is so interesting about the company is the variation in analyst opinion about what this company will do. If you go to Yahoo and take a look at the analyst consensus numbers, they're suggesting that the growth rate should be 2 to 3%. You compare that to the suggested growth rate from Morningstar at about 20%, and you begin to see why studying this stock takes a little bit of time, and you also have to hold on tight. We have found that the stock is extremely volatile, but we have cut it back 4 different times in the period that we've held it because it's become too large a part of our portfolio. And just yesterday I was checking the portfolio, and NetEase has risen to the top in our holdings once again. It's an interesting stock. Take a look at it. I'm not sure that it's a buy right now, and creating an SSG is you're going to depend on information from a lot of sources, and those sources are going to be really disparate in what they predict sales growth to be, and earnings growth for that matter as well. Very, very interesting stock. It is Chinese. It is an ADR. It is only sending data to the U.S. once every 6 months. So with all those caveats, have a good time taking a look at it.
Well, I would point out it's only been selected once or twice, so it's actually done very well for the roundtable also. And again, a lot of household names on there. Mesa Labs I missed on the not in the standard edition. That's one of our favorite small companies, and we'll talk a little bit more about that later. Ken and I are in the middle of trying to dig up that list of best small companies as Halloween approaches this year. So again, let's drill in and take a closer look at what the portfolio looks like. This is we're going to just skim over this here tonight, but again, just to reinforce some of the stuff that we've been talking about over the last several months, is we don't think we should change a bit the existing selling guidelines, the ones that basically are you only sell when you need the money or if you can make the portfolio better. That's what point number 1 is, and it actually covers point number 2 also. If you need better quality either in the overall portfolio or if you have the quality of an individual stock degrading, it could be a reason to sell. We are talking about using relative return as a trigger for selling stocks probably in the first year of holding, and we're going to talk a little bit more about that probably next month. It's just the notion of, we've noticed that some companies just simply don't work out, and they kind of fall apart fairly rapidly, and they generally fall apart within the first few months of ownership, and it's kind of a concept that we think might add a couple of points of long-term performance, percentage performance, and kind of excited about it. But this month I thought what we would do is just take a quick look at that, make the portfolio better from our traditional approach of, we basically want to design and maintain the portfolio to have enough return. As you can see on the right, the projected average return of the portfolio is 9.9, so approximately 10%. The median return forecast, my par, at the top of the page is about 6%, 5.9%. We'd like to really stay about 5 percentage points above that, in that so-called sweet spot that you can see there, color-coded in green. We're a little bit short of that, so hopefully the stocks that we pick tonight will boost that a little bit, but over time we do want to be weeding and pruning the companies that do have the lower return forecasts also, in an effort to maintain that. Overall quality of the portfolio is pretty good. We can tolerate some lower quality companies, but at 85.8 that you see in the second slot there, that's pretty sufficient. We'd also like to constantly, continuously, persistently be on the lookout for higher growth companies to bring to the portfolio to keep that number at hopefully at 10, 11, maybe even as much as 12%. So somewhere in that 11%, give or take, range for the overall portfolio, and you can see we've slipped down a little bit to 9%. Companies that you see on the left have been ranked by their return forecast from lowest to highest. They're the 10 that have the lowest return forecasts in the portfolio right now. So I did go through and do a quick audit of expectations for those. Pushing to this page, those are those same 10 companies. A couple of the audits, for example, Ken was talking about NetEase. There's a real diverse spread, a wide spectrum of opinion on the growth rate. And a recent update actually kicked a little bit into the fair value forecast for NetEase also. So we actually got a little bit of a bump in that fair value. That kicked up the return a little bit. You can see none of these are now negative after a quick update today. But by the same token, none of these are exactly setting the world on fire either. The Morningstar price to fair value, which again is comparable to the methods that we use, don't suggest that any of these are screaming buys, certainly, and certainly they're in the hold range, if not trending towards the sell range. The other thing that we are looking at is things like ConocoPhillips, a little bit less traditional stock, a little bit more non-core, very high expectations for the next year. That might be a compelling reason just to, keep that in mind. But again, the update actually takes any of these out of the negative. None of them are anywhere near the buy zone, but any thoughts on what you see here from any of the three of you?
Well, Mark, I learned a lesson with O'Reilly Automotive when we first began working with Manifest. One of the rules of Manifest was as your par approached zero, if you needed more par in your portfolio, then you sold some of those companies that were down around zero. And we owned a fairly large stake at that point in O'Reilly in one of the model clubs, and we did need to up our par, so we did sell it. That was maybe 5.5, 6 years ago. It's been on our pounce list ever since, and we've never been able to get back into the stock. And meanwhile, it's more than doubled in that period of 5 or 6 years. So when a stock is really behaving in an upward direction for lots and lots of years, and there's that huge variation in what the analysts are thinking is the correct sales growth number and the correct earnings number, I'd be afraid to sell NetEase at this point. I guess we only have one, maybe two positions in it. I would like to keep that in the portfolio. Morningstar price to fair value at only 111% means it's just slightly overvalued as far as they're concerned. So I would not like to play with NetEase. A lot of the ones on this list are what I would call non-traditional stocks. They're maybe a little bit more focused on catching the right trends and everything. If you wanted to move out my choice of U.S. physical therapy, I know that I chose that at least once, and maybe other folks have too. I wouldn't be opposed to moving that out with that par of 3.6%. But those are the only two that I would feel comfortable speaking to on this list. Maybe Massimo as well, but Massimo seems to be behaving fairly decently. I do notice that Value Line has a negative low total return on that stock. So there's my 2 cents for the list here. Hugh, you have a lot of stocks on this list. What do you think about freezing our position in any of these?
Yeah, I was noticing that as well. But, you know, companies like ConocoPhillips and Caterpillar, I buy these companies for the long haul. And Caterpillar and ConocoPhillips are going to be depressed, I think, for another at least 2 or 3 years. Maybe Caterpillar in particular, because, you know, it's going to take a while for it to recover from the glory days it had selling things to China and Australia and other countries like that as commodity pricing went into a kind of a bubble. So I tend to hold on to these things for a long time. The goal is when you hear about the word diversification, and it's thrown around actually. If you walk into a brokerage and one of these little financial planners wants to talk to you, and you give him or her the time of day, then they will talk about diversification, and it's a very threatening word because there's no right way to do it, really. And the big question I've always asked them is, when should you be diversified? Should you be diversified at every second of every day, which means you're selling and buying all the time? Or should you be diversified at a given point in a year? Or the way I look at it, should I be diversified when I retire and need the money, and therefore needed to be safe and growing at a steady rate and nicely balanced, etc.? Right now, I'm building a portfolio. I don't view myself as owning one. So I'm not as obsessed with diversification as I would be if I were 10 or 15 years older. I think diversification is a consequence of good investing and a consequence of good long-term thinking. And I've often wondered why it needs necessarily to be an ongoing process when you're building a portfolio. Because you will want to put things in your portfolio which people don't like, because they will be out of favor and they will grow in the long term. And we look at some examples later on, we'll see Microsoft, which was grotesquely out of favor for a long time, but is doing quite well now. And I would say the same for ConocoPhillips and Caterpillar, and for that matter, maybe Intel, that's close to a high actually. So I'm not too sure how successful its growth will be over the long haul. But Caterpillar and Conoco certainly will. So I would tend to hold on to them. Now, I don't think eBay may be mine. I can't recall. I know I was buying it at one point a few years ago. I didn't know if I added it here. But US Physical Therapy, ABB, Massimo, they're not mine at all. Or Schlumberger, Tyson, for that matter, and NetEase. But I'm kind of with you, Ken, in that not only have I had seller's remorse, but now I have anticipated seller's remorse when I ever think about selling, you know? It's a very hard thing to shake.
Well, I'm with you on everything I've heard so far.
A very short question. Sorry about that.
Oh, no, not at all. I mean, in fact, I'd take it a step further. We recently did that analysis of David Gardner's Rule Breakers portfolio. It's been a couple of months now, but he's got 60% technology, and just cranking out a 10% relative return to the market over 15 years, and I mean certainly breaking all the diversification rules, at least with respect to sector. And again, one of the things that Ken and I like to point out when we make the presentations that the term sector diversification is not even in the handbook that Nicholson and O'Hara put together back in the 80s. So sometimes people get a little bit too preoccupied with that sort of stuff. I'm with Ken, though. I think U.S. physical therapy may have run its course a little bit, even though it's got a decent growth rate. And eBay, I think it would be worth taking a look at possibly replacing it with something like Mercado Libre. the Latin American eBay, perhaps next month. It just about made the list. It's been red hot. Ticker symbol MELI. It really has been red hot, and on a pullback, maybe we could make a move there. That's a stock that we've liked over the years. So anyhow, nothing's actually.
One of our guest knights that originally put Tyson Foods in the portfolio, Herb Lemkel, if you're reading the question pane, Mark, you'll see that Herb has put up a pretty lengthy post about the earnings call today from Tyson Foods, and the upshot of the whole paragraph is that he thinks it's something that we should not be moving out of the portfolio at this time. And you know, with a 5% par, that's only about 1% less than average. I agree that probably it doesn't need to be moved out at this point as well. I'm really intrigued by these ACE numbers, especially for Schlumberger and for ConocoPhillips. You know, the analyst consensus estimate for growth on ConocoPhillips is 35%, and for Schlumberger it's 25%. We have a comment from Carol Clemens, who lives down in the oil patch, that offshore drilling is probably going to be a year away before it starts the upward turn of the cycle. I think it would be a mistake to classify Schlumberger, however, as an offshore drilling company. I think that they provide materials to almost anybody drilling for oil almost anywhere in the world. Would somebody, do you think that's a correct characterization of that company?
Oh yeah, anywhere that it's done, including offshore.
Yeah.
Yep. So again, Tyson is also a great case study. I think it falls into that category of companies we discussed in Indianapolis this weekend, where there are improving margins in a lot of food-related businesses, and I think Tyson is one of those. That the margins are ramping up and going higher than anybody thought. It's one of the reasons that Warren Buffett's been buying some of the Crafts and those type of companies. And sometimes you just have to admit that there's things going on that just simply are not accounted for yet. Some of these situations. So I would say table it for now, and let's take an aggressive look next month when we pull this out.
I would tend to agree with that, Mark.
And maybe we'll have a handful or a half dozen exciting small companies that we'll want to go for it with too.
Okay.
All right. Let's go ahead and launch into the stock presentations. We can come back and talk more about that subject during the Q&A, but we'll get things kicked off. Kim presented Novo Nordisk last month, and she wants to repeat. She feels so strongly about it, and bring it back again this month. So take it away, Kim.
Well, thank you, Mark. As many of you know, we hear from Ken very frequently of up, straight, and parallel, and you can see right here, Novo Nordisk is pretty much up, straight, and parallel. It's not a straight uphill by any means, but if you know, I want you to think back, how many of you in the audience know someone who is a type 2 diabetic, got diagnosed in their 40s and 50s, and ending up they are on an oral medication or on insulin, or even those type 1s who were diagnosed as a child. Well, Novo Nordisk is the #1 manufacturer of insulin in the world, and unfortunately, diabetes is just growing by leaps and bounds. Next slide, Mark. I got this slide from the International Diabetes Foundation, and currently we have 415 million people who this disease affects, and in 2040 they expect to have 642 million. All it is doing is growing by leaps and bounds, and unfortunately, when this keeps happening, more and more people are going to need medication to manage their diabetes. This is also a play on, truthfully, I believe, human behavior. We have a tendency to be a little sedentary and not move as much as we should, and that can lead to diabetes. So, next slide.
Kim, before you get off that slide, the colors are just coded to go with the number growth that accompanies the map. Is that clear? Is that correct?
I believe so. I'm going to send, I sent Mark the whole PDF file that they had on the world view of diabetes, and I'm hoping Mark can then post it tomorrow on the forum.
Will do.
Great.
Yeah.
Okay, but this isn't necessarily saying it's going faster here and slower here or anything. It's just reflecting where the aggregate numbers are coming from on this particular graphic.
Right. It just shows where
Okay.
where it is growing at, and truthfully, it's
Yeah.
growing everywhere, and it's getting worse. It's not getting better. You know, most times in healthcare, we want our disease processes to get better, but not worse, and unfortunately, that's not happening. This is the last value line from Novo Nordisk. The recent price on this value line came out was $52.23, and today it closed at $43.85. I personally, when I like to look at a value line sheet, I like to look first at the projections box and see where the low percentage of total return is 10%. That's a minimum. I've learned the hard way to have minimum criteria, and that is one of my minimum. One of the other things is you can see up here where the PE ratio is 21.8, but that was at a price of $52.23, and the median PE is 20. I would hazard a guess that currently that PE is probably right down at that medium or below that, and I like looking for companies in my portfolio when I'm buying them to add to have them, the PE is lower than the median. The other thing I like is where you have this graph that's in the middle, and I don't know if a lot of you realize, but the dot, 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 and over on the far right hand side, that is their projection by your value line where they think the low price will be 70 and the high price 95. That's the little channel where they think the stock price is going to go to. So anytime I can see the solid black line and the stock price is underneath it, that's a little way you can also look that the stock price is undervalued. Next slide. I have some things that I like to look at as a checklist of when I look at a value line to make sure I am consistent. One of them is to make sure on the second line down, is the cash flow per share growing? And then you can see with this stock, it's kind of getting to be a cash cow. My goodness, they're going to go on out to have $4.30 per ADR. And that's a lot of money. And that's great because look, how much capital spending do they spend per ADR? That's only 40 cents. They've also been able to consistently, they're growing their book value. They've got what their annual PE is, and average is 21. And like I said, I bet you right now that PE with a stock price of $43.85 is lower than its average. Currently, you can see where the sales, they want to project out to $226 billion. And look at that. I love an operating margin, which is 45%. I recognize it's been jumping back and forth, but that's fine. We are staying consistent in the sense that it's in a pretty tight range. The other thing is I like to have a company with their net profit margin is rising or staying consistent. And here it is, we have it again. The other thing is I'm also looking at shares outstanding, and truthfully the other thing is because I missed that one, the shares outstanding are going down. So just by looking at these, this will tell me that this is a well-managed company because the management is nice and consistent. I always look to see if they have any pension obligations, and they do, but it's nothing really outstanding because it's only $331 million for their pension. Next slide. From the value line, this is the annual rates of where they think the sales are going to go at 11.5%, and the dividends will be a little bit lower, but look at that. They're still going to be growing that book value. Now, I know some people have had a hard time finding where they think the long-term growth rate will be for this company. And the company's had some challenges. If you've got margins that great, you're going to get a lot of competitors. And Eli Lilly has gotten in there, Asanto Adventis. And I know that the FDA has asked Novo Nordisk to go back and do some more testings before they're going to approve one of their drugs. And I believe it's Eli Lilly has been nipping at their heels. But when you've got that kind of fat margins, you're going to be okay for a long time. And now if you look at this, they're predicting that their earnings growth is going to be at least 10%. I'm not going to complain with 10% when a company is as big as it is. Next slide. Here are the earnings forecast. If you want to do, because we always say here on Manifest, always do your own judgment on this. And so I found earnings forecast here. And one of the other things I like on my checklist, I always like to look at the financial strength. Each one of us in managing our portfolio, we want to make sure we've got management that's got who are great stewards of our capital. And at a financial strength of A++, I don't think you can get it much better than that. Next slide. This I picked off the Manifest website. They believe the potential annual return is 14.9. That's really close to our 15% to double every 5 years. The quality is outstanding because it's at 99%, and even the Motley Fool rating is at a 5-star. You've got everything that's good there when you're looking at overall. Next slide. As far as the drug stock in the top drug area, you've got Novo Nordisk #1 at a par of 11.9 and quality of 99. And in healthcare, it's #2 behind Celgene. We have always been told that you want to have the best of the best in your portfolio, and I believe Novo Nordisk is. So that's why I'm presenting it again today, as last month. You can see that I like personally having stocks within my portfolio that have international growth. You can see where the share of growth has been in the U.S., Europe, they're international, China, the Pacific. They're making money across the world. So it's just not one market that they're making money in, or one part of the world. Next slide. They do have a couple different divisions, but diabetes is obviously the #1, and they are #1 in that area. Hemophilia is they are #2 in that market, and in growth disorders, they are #1. Next slide. Unfortunately, the growing diabetes market is that it keeps on growing. So you can see, and this is all the information from their May 2016 presentation. The nice solid blue line on the right-hand side has 27%. That's of the global diabetes care of market share. So they are the leader in that, and then here are all the other competitors that they have, which are below it. They're a leader, and they're great stewards of capital, and you've got an excellent management team. I can say that right now, it was announced as of September 1st, the CEO is going to retire at the end of this year, but the new CEO is a 25-year veteran of the company. So it's not somebody new who's going to be leading the company. It's someone who's been within the culture of Novo Nordisk to be leading them forward. Next slide. They have lots of growth, and all that extra cash that they have, they like to return it to shareholders via dividends and share repurchases. And that's great because they're growing the company. They're building a new plant in Denmark with their free cash, as well as they announced just today that they're going to have a $510 million stock buyback from August the 5th of this year to August the 26th. with all that free cash that they have, they're a huge cash cow. They've got no debt, and they're growing the company internally without having any debt. I like those kind of companies. Next slide. This is one of the I think I've got to say, this is the only company that I know on their investor relations site. Every week they post something which will tell you, because they are from Denmark, and that is the kroner, which is the DKK. They announce and tell you at what price are they buying back their shares, and 9 out of 10 times I feel that most companies are buying back their shares when the price is way too high. Novo Nordisk, being great stewards of the capital, are buying back the shares when the stock price is low. This is great, and they actually announce it on their website so you can follow it. Next slide. If any of you do any of the technicals, this I got from Stock Charts after the close of day yesterday. As you are aware, sometimes when if you look at that, the RSI, which is the relative strength index, says it's at 33.08, and whenever a stock is at 30 or below, it is oversold, which is the market might be throwing out with the bathwater with everything else. So always do your own judgment, evaluate the company yourself, but if you happen to look at any technicals, this is one of the technicals I also do look at. This is telling me that this stock is probably undervalued right now. Next one. Now, one of the things you need to be aware is because it is from Denmark, they have a foreign tax obligation for their ADRs. Each country has a different tax rate. For Denmark, it is 28%. But the IRS allows investors within this stock to either take a tax credit or a tax deduction, so you don't get the double taxation. So unless you have lots and lots of shares that you're going to have over $400, it really doesn't affect you. It's just another form that you have to fill out yourself or have your accountant fill out. But down below is where I found this information, and it talks about, it has a whole list of all the countries and what the tax rates are for those countries. I hope that you find that beneficial. Next slide. I found an article that was on Seeking Alpha, and this is how he had said, we want our money to double every 5 years, and if you look from 2006 to 16, their sales have doubled at 231%, cash flow has gone up 421%, earnings 557%, and dividends up 860%. I can't say anything bad. I think this is a well-run company. They reward the shareholder, you, if you just choose to own the stock, and this is one of those stocks that I have. I'll admit it's in my portfolio, and I don't worry about it. I just let it run its course because every stock will have a 52-week high, 52-week low. Right now we're getting into our 52-week low, so I don't mind buying more shares to reinvest at the low. Next slide. This is another thing that was in that article, and it talks about when you had the red stars is when the stock price was overvalued. The green is when it was undervalued. And you can read the article, make your own judgment on it. And as you can see, the annual PE down here at the bottom at 21 is also one of those times when it is at the very bottom of their PE, so that they do quite well. Next slide. Warren Buffett believes that you need to have a portfolio that a monkey can manage it, because sometime eventually it will. And I have to admit, currently I'm in a monkey managed portfolio because I'm here in Florida taking care of my parents and helping them because my dad's got leukemia, and I don't worry about this stock. So if you would like to have a stock within your portfolio that you really don't worry about because you've got great management with capital allocation and they share their profits and free cash flow with you, the shareholder, this is a stock I would like you to consider for your portfolio. And thank you.
Thank you, Kim. Bringing back the career builder ads. Good stuff. All right, Ken, we'll go ahead and turn to you with Mednax, ticker symbol MD.
Okay, if you'd click once, Mark. Mednax is a fairly small company, $2.7 billion in revenues. So in our system of classification, along with the growth that it's experiencing, I think we would have no trouble saying that it's a small, mid-sized company. It's been around for a long time, over 30 years. It started out in Florida with an $80,000 valuation and just a couple of assets, and it's grown to be a national presence with assets in a lot of different areas. Click, please. Mednax on a single day will touch these kind of patients, and some of these you'll recognize and some of these you need a little bit of explanation for, but it gives you a little bit of idea about the scope of the company and how many different people they would touch on a daily basis. Next slide. The value proposition is that this company is creating opportunity in a lot of different places. One of the driving forces behind most hospitals today is managing their costs. And many hospitals are deciding to not run their own programs in some different specialties. Just specialties that hospitals and standalone ambulatory centers are beginning to farm out are neonatal services and anesthesiology services. And those are the two biggest units that Mednax puts together. Mednax will put together a group of doctors, a group of people certified in these various disciplines, and then bid to run the program for the particular hospital or standalone facility or whatever it is that we're talking about. And again, its largest presence is in neonatal services, and anesthesiology is the fastest growing segment, but they have some interesting growth coming from some of the other segments as well. Click again, Mark. Just if we look at neonatal services, there was a recent study done by Pediatrics, and that's an organization, a nonprofit organization, and they have found that patients that are using the neonatal services from Mednax have these percentage decreases in these particular types of problems with the neonatal patient. Mortality in very low birth weight infants, for example, is 22% less than you would expect in the peer group. Late onset infection is more than half, is less than half as much as you would expect in the peer group. So they're exhibiting some real success in this area, and that's driving customers to their door. Click again, please. Their fastest growing unit is in anesthesiology. Hospitals used to have their own anesthesiology departments, and more hospitals are opting to outsource that whole department to a company of some sort. I had direct experience with this when my wife and I were caregivers for my mother. We discovered that the heart units at all of the local hospitals basically had been farmed out to the same group of heart doctors, so that no matter which local hospital we went to, and we had 4 of them that we could choose from, we were seeing the same group of doctors that were in charge of the heart programs. Well, the same things are happening with anesthesiology. You can see the footprint that exists today, and the company has lots of room to grow. There's a large part of that map that does not have a state with a unit in it at this point. So it's a really good growth opportunity for the company. Click again, Mark. Here's the fastest growing unit in Mednax is teleradiology. Most of you, I think, know what a radiologist is. It's a doctor that reads and interprets X-ray and MRI results. Well, a teleradiologist would be somebody that does this long distance. and they might offer those services to a number of different hospitals or a number of different standalone units. This is the fastest growing segment of MEDNAX. Again, you can see the footprint on the map of the United States. The darker the color of the state, the more teleradiologists are located in that state, and the more customers are using those services in that particular state. Click again, Mark. The way that teleradiology works is that you start out with a certain group. Well, first of all, you hire a large group of radiologists on your staff. So MEDNAX has a large group of board-certified radiologists on their staff. And when you get a set of, let's call it a set of x-rays, for example, when you get a set of x-rays in, the first thing you do is you do a kind of a coarse sieve, and you decide which of your radiologists are in the right field to deal with this problem. And then you can bring it down finer and finer and finer until you end up with radiologists that are specifically prepared in the exact field that the X-ray do, and that happen to be free to take on that particular case at that particular moment. I think they do a nice job with the words at the top of the slide, getting the right study to the right physician at the right time saves lives. And hospitals evidently are agreeing with this strategy because more and more of them are opting for this teleradiology rather than employing radiologists themselves at their own facility. Click again, please. MEDNAX also deals with management services. Everybody understands that healthcare reform is creating much more complex reimbursement challenges for physicians, for standalone facilities, for hospitals, for anybody dealing with healthcare. There's more complex to figure out how you're going to get paid. Poor collection of patient balances is a big problem, is one of the biggest problems that we're facing today. That's a kind of a chilling statistic that 75% of patients are willing to pay, but only about 19% of them actually do. You also see that there's an increased cost in patient pay responsibility. So in 2005, only about 3% of patients were paying right at the time the services was rendered, and that had grown to 35% in the current healthcare system, and the estimates are that 50% of people by 2020 will be dealing in some form of direct pay. So MEDNAX sees this as a growth opportunity, and they're providing these services. It's called RCM, and I hate it when they use acronyms without telling me what it is, but that stands for Revenue Cycle Management, and what that basically means is just eventually getting your money, doing enough work to get your money to get the bill paid. So click again, please. Up, straight, and parallel, I can't emphasize too much. And before you ask the question, no, those two relatively flat quarters don't bother me very much. They've had flat quarters before. You can maybe look back to the recession, and I don't see a lot of disruption in this company during the recession, but there are a couple of times, if you quarter by quarter numbers, where you'll see periods of 1, 2, sometimes even 3 quarters where revenues, where earnings per share flatten out just a little bit. Notice that the price bars have flattened as well, and that the company is trading near a 52-week low right now. Click again, Mark. This is from the Better Investing Online Stock Selection Guide, and I've set growth rates for sales at about 11% and for earnings per share at about 14%. I see that the trend on margins is slightly down, but when I actually look at the numbers, I'm not nearly as concerned about that red downward trend as I might be. The numbers are clustered fairly close together, and the sources that I've read indicate that the outlook for margins is stability or even slightly increasing. Return on equity is going in a nice direction, and the debt seems to be manageable. Even the most recent debt, which is the highest in a long time, and due to a number of acquisitions, even the most recent debt is very near our goal number of around 33%. I will indicate that the company is not afraid to borrow some money and I looked at their bonds, and they're borrowing at 2 and 3 and 4%, which are extremely low rates, especially when they can grow that money at a much faster rate. And their interest coverage right now is better than 13 times, which means that they're going to have no problem paying the interest on their loans if they should be faced with some type of catastrophe. Here's section 3, the historical numbers, and I chose just to use the historical high average and the historical low average. If you'll click again, Mark. As I did my choosing of high and low price, there's the zoning. I did capture a Value Line annual rates box just to give you a little bit of comparison. Value Line sees sales growing at 13. I was a little bit more pessimistic. Value Line sees earnings growing at 13. My preferred procedure suggested maybe 14. So all in all, I'm running close to Value Line projections. I'm not especially worried. This gave me a buy with about a 5-to-1 upside downside. Click again, Mark. I'm getting a par value of about 13 point something or other, and then I compare it to Manifest. I use Manifest as a validation of what I do on my own analysis, and when Manifest comes in at 13.3 and my SSG comes in at 13, I think that's a 1 right there. Boy, I'm really pretty happy. I think that they're both telling me essentially the same thing. Click again, please. I'm looking at projections from Value Line. At a slightly higher price, Value Line was saying 7 to 14%. With the price a little bit lower, I think that those numbers are probably somewhere in the area of maybe 9 to 16%, something along those ranges. Again, I'm very comfortable with that. Here's the numbers that Mark gathered from the analyst consensus community. And you'll notice that that yields that 13.3. You know, I really didn't have any strong disagreement with any of these numbers. If anything, I might have lowered the share count just a touch. I think Mark is using 90.3. Mark, if you could run your cursor around it there. That's a 92, isn't it?
Mm-hmm.
And when I did my preferred procedure, I think I used 90. But essentially it's the same analysis, and it's going to yield very close to the same par value, around that 13%. I'm very comfortable with that. I think that I'm looking at a good, solid, medium company with a lot of room to grow, and it's in an area that I think right now is being overlooked by the market. I noticed that we have a couple of questions in the question queue about why is Novo Nordisk trading at a low? Why is Mednax trading near a low? I just don't think that healthcare is a favored sector at the moment. And I think that healthcare, a lot of it is being beat up by the politicians, but I don't think that we're looking at two companies right here that, when it's all said and done, are going to get too involved in the whole political your price is too high argument, that type of thing. I like what this company does, and more importantly, I think it has a huge amount of room to grow. It seems to be doing a much better job of growing than any of its competitors, but I don't have time to get into that particular argument right now. I think I have one more slide, Mark, am I right? Yeah. I love it when Value Line concludes their analysis with a paragraph like this. You know, it's maybe 1 out of every 5 or 1 out of every 8 stocks concludes with this type of paragraph. And I love it when it tells me that it's going to have some problems this year. That indicates to me I can pick it up at a bargain price, and then they're suggesting good quality appreciation out for the next 3 to 5 years. They don't use the word good in a cavalier way. When they say good, they mean good. So all in all, I'm fairly pleased with everything that I've read about Mednax here, and I would suggest that we'll add a position to the tracking portfolio and see how it does over the next couple of years.
All right. Well, thanks, Ken. Yeah, I would say those type of words coming from Value Line, he would change those to basically say this is probably an accumulation opportunity and probably have some time to do some accumulating. So, all right, let's go with our third stock here. I'm going to go ahead and present Norwegian Cruise Lines, ticker symbol NCLH. You can see that it's a company that does not have a particularly long track record by the visual analysis on the right, but I also want to point out that this is not simply because I was on a boat last week, and there's no extreme bias here. That they actually did end up near the top of some screening results. You can see I've included all the estimates for the company. Back on August 5th, the company was trading closer to $42 a share. Couple months or almost 2 months later, you can see that it's trading down closer to 38. So it's actually had about a 10% hit. It's basically taken a pretty good hit on the heels of Brexit and just some concerns over the general nature of recreation and the recession that is continuing to be somewhat of a global recession over in Europe and much of the world. You can see that Value Line believes the company will grow at 15. I chose 11 with higher projected margins than I was willing to go to after taking a closer look at the company. In the bottom line, a little bit higher PE from me. The bottom line is still in a 20 to 23% range on projected return. They don't pay a dividend right now. And you can see that that low total return forecast that Kim emphasized is, again, mid to high teens. So fairly interesting looking company, at least from a return perspective. It's always fun to stack up and do a quick mini industry study. In this case, I just created a quick dashboard so that we could do a quick comparison between two of the more major players within the cruise industry, Royal Caribbean and Carnival Corporation, the two that you see here. You can see that they are a little bit larger and established. They have more mature growth rates. They probably don't have the same opportunities for geographic expansion and fleet expansion that Norwegian does on a relative basis. You can see PEs in the mid-teens for all of these companies, and fairly decent quality ratings across the board. But again, on stacking up the return forecasts side by side, Royal Caribbean is compelling, even if challenged by some of the stuff that's going on right now. In Norwegian, this is quite significantly higher. The analysts have the growth rate even higher than I would be willing to go, and so the analyst consensus has it in the 20s. They're bringing out, they actually have done some renovation of some of the yachts, and they're putting together a fairly big fleet. And I find it kind of compelling that they are adding destinations like China. They're going to start Chinese cruises next year, and the photo inset at the bottom is Belize. They're looking at Cuban destinations, Belize, just some fairly interesting and compelling opportunities. That picture that you see there is actually one of the rooms on this, as it says right here, built as the most luxurious cruise ship ever built. Fairly fancy stuff, and they're seeing pretty good business. Fairly recently, Barron's had an article written by Wedham Securities that talked about the cruise industry, just capturing some of the spirit of what's going on, the European pressures that are out there. The Brexit thing did seem to mess a few things up, but these guys do seem to be doing fairly well and maintaining growth, and they have some decent expansion plans. And again, the whole idea is that for whatever reason, seasonal sentiment, if you want to think of it that way, they tend to get kind of gloomy this time of year, and in advance of the fourth quarter and the first quarter, it can be a good time to look at these from an opportunistic standpoint. The Caribbean market is solid. It's, as it says here, rock solid, with very few vacancies right now in the way things look. Here's a look at the Stock price over the last 3 years, again, as Kim pointed out, anytime you get that relative strength approaching 30, you are approaching an oversold condition, perhaps, theoretically. This is kind of a situation that also probably shows a sell-off of some of the restricted shares after the company IPO a few years ago. But you can see that the price has actually come back down to the higher 30s from a high closer to 65, so it actually is fairly deeply discounted for the challenges being faced in the marketplace. And again, I think it looks like a pretty good opportunity with decent growth characteristics and one of the industry leaders in the cruise line industry. So I'm going to go ahead and add NCLH to the tracking portfolio. All right, let's go ahead and finish up the stock presentations. We finally found a picture of Hugh McManus where he doesn't have the green hat on, so we thought we'd share that with the audience. And in keeping with the cruise team, you can see he's standing there by the body of water. So let's hear from Hugh on Bristol-Myers Squibb.
Hey, good evening, everyone. Hope everyone can hear me okay. Yeah, I liked the discussion earlier on diabetes because it's scary, actually, how bad it is. And people think it's unique to the United States, but it is global, and in places that you wouldn't expect, such as Saudi Arabia and Malaysia, where it's significantly worse than here. And I blame refined sugar, but that's neither here nor there. But there's an extremely good book, if anyone's interested in it, called Fat Chance, by an endocrinologist based in San Francisco and practices in this area of obesity. But it's an excellent read. It involves a little bit of technical because it goes through all of the processes in the body, now sugar is metabolized in the different sources, and how it's a scourge of our diet. And cutting out refined sugar can have long-term and almost immediate health benefits. People can do that. And of course, all pharmaceutical companies are in endocrinology to some extent, but to a significantly lesser extent is Bristol-Myers Squibb, which is the presentation here today. And I spent way too long trying to figure out why I couldn't list it. And then I found out that my membership in the organization had lapsed. I guess I didn't update the credit card, and maybe I didn't read all the emails. I get a lot of emails, but I mustn't have read the alert telling me that your membership had lapsed. It would have lapsed, well, not recently anyway. So I have to get that fixed. So apologies I don't have an SSG in here. I didn't want to do one by hand because I couldn't find the old charts that I used to have there in storage. I'm going to keep them. I'm going to be worth a fortune one day. So let's move on to the next slide for Bristol-Myers Squibb. And I do the same methodology I always do. I look at companies that I'm interested in for various different reasons and see how where the price is as a function of the 52-week high and the 52-week low price. So how close is it to, on that range, how close is it to the low? And the Bristol-Myers Squibb, the close of business today, or maybe it was yesterday, is just over 3% of the way to the bottom. It's almost at its 52-week low. And I tend to favor companies, if they're solid companies and they've got long-term growth prospects, I tend to favor companies when they're cheap. I also like it if they've got a high dividend, although that can be a bit troublesome because companies that get into trouble and continue to pay a dividend have a low stock price and the dividend yield increases, so you have to be really good. But I do like a long, stable track record of dividend payment. Certainly BMS, which is not the ticker symbol, BMI is the ticker, has that. So let's move on to the next slide, and you'll see the area that I'm looking at, which is the companies close to the bottom. I like it within 10 to 20% of its low price. And skipping along to the next slide, I've talked about this before, I favor mid-sized to large companies. I take risks on small companies periodically, as you know. And on the next slide, I just blank out those that I don't want to look at right now for a host of different reasons. And it boils really down to Staples, Starbucks, Disney. But BMS, which has a better dividend yield, except for Staples, is a company that I haven't bought in a long, long time. And its price is near its 52-week low, so now is an opportunity. So if we go to the next slide, by the way, as I said, I spent way too much time playing around with trying to figure out how to do an SSG. But so I will just talk through this. It is a stable company. It has a very good debt situation. In fact, if anything, it could afford to add more debt to its balance sheet, but doesn't want to do that, so that's fine. Doesn't need to do it either, for that matter. It has a very good pipeline, but it's it's back-loaded. It's not front-loaded. In other words, it doesn't have many drugs in the pipeline that are about to get approved. And that's a problem for analysts right now, particularly those with a 3 to 6 month time horizon. I'm being generous here. Let's call it a 3 month time horizon, or a 1 week to 3 month time horizon, or whatever the short term is. Price fluctuates, and the stock price has been hit by recent bad news. We'll get to that in just a bit. Just on the next slide, there's just a picture of how the stock price has been climbing steadily for the last 5 years, but it does fluctuate here and there, and it accelerates up periodically, and it charges down on occasion as well. And many of these sharp jumps or sharp collapses are driven by news, particularly news that has to do with the pipeline. So let's go to the next slide, and I think I will skip through these because, this is the quote-unquote bottom of the heap. These are companies that are near their 52-week high, and FedEx always seems to be near a 52-week high. Amazon is doing spectacularly well, but there's a lot of solid companies here, and I talked about Microsoft earlier, which is now almost $60 a share. It's actually, I think it has now surpassed its all-time high, which it hit in March or maybe February of the year 2000, just right at the time that the bubble got burst in the dot-com. Okay, so let's jump ahead. And what I did here on the next slide was I looked at the balance sheet, the income statement, and the statement of cash flows. But we're running out of time, and we don't really need to go through these in great detail. But the one recurrent theme about all pharmaceutical companies is they have a lot of debt. They spend an awful lot of money on R&D, and you'll see that as a percent of revenue. You'll see that on every income statement. You'll see that number, and it's well worth tracking. And it's well worth making sure that that number is actually producing results. It's actually producing drugs that can get to the market. Yeah, there it is. And because it's significant, it's a relevant number as a percent of revenue. You can see that 5.9 billion as opposed to revenues of 16.5. That's a huge chunk of change. It is reported, and sometimes they'll break it down into more details. And the next slide is the statement of cash flows, but I don't want to go in here. You see a lot of it's negative, not a bad thing necessarily. And the change in cash and cash equivalents for the last fiscal year that was reported is negative, and there are various reasons for that. You can see that there's activity in accounts receivable and some activities in investments. And pharmaceutical companies are particularly difficult to analyze. As was pointed out earlier, they have a lot of their business overseas, so there's a lot of different tax regimes. And many of them have their headquarters or significant activities in low tax countries. They do a lot of things to minimize tax, including having their IP offshore in a Caribbean state, licensing it to a manufacturer in a low tax environment, and then retaining as much of the workable profit that they can overseas to keep it away from the horrendously high 39% tax rate that we enjoy for corporations here in the United States. As we've heard many times in many articles, it used to be the lowest corporate tax in the world. Today, it's among, if not the highest. So let's skip along to the next slide. There are 6 main areas of research: cardiovascular, fibrotic disease, genetically defined diseases, immuno-oncology, which we hit there recently, immunoscience in general, and oncology. And genetically defined could involve actually diabetes. You go on the website, you see a really nice representation of its pipeline. And the pipeline represents the future, and therefore it represents what drives the stock price. It defines on the left what the compound does. And this is phase 1. So this is the early risk phase, where you're basically trying to figure out, is this therapy safe to administer to human beings? After all the animal studies are done, once you start administering to humans, it's called a clinical study, not preclinical. And most of the things on here are what are called biological molecules. They're large molecules. If you went back and looked at this pipeline, even 10 years ago, the bulk of the molecules here would be small molecules, traditional drugs that we all know and love, the Lipitors of the world, the aspirins, etc. The small chemical molecules have been replaced wholesale in pharmaceutical companies by large biologics that are made through different techniques. They're made through fermentation. And these are large molecules. They're hundreds of thousands or even millions of times bigger than the small molecules. And they are often administered, the route of administration is often as an injectable. So if we skip to the second slide, next slide, we can see the phase 2 pipeline. Again, very healthy. They have a lot of, and if you get, they have a lot of different programs here, and many of them are doing quite well in a host of different regions. And by the way, if you look at different pipelines, you get used to seeing things like this BTK inhibitors, or things that are pegylated, or nitroxyl donors, etc. You see these time and time again in different pipelines of different companies, and it's a good thing if you're investing in pharma to look at the pipelines of competitors, because you get an idea of what's a hot area of research, what are the new drugs that are coming on the market, and if there's one already on the market, you can see what potential competitors it might have. And then finally, when you look at phase 3, and this is the last stage, the one that involves an awful lot of cash, a lot of investment, thousands upon thousands of patients to ensure the drug is not only safe but also effective. And here we only have one. That's a bit of a problem, because it means that additional revenue to Bristol-Myers Squibb will not happen until these phase 2 drugs mature into phase 3 and get to the point of getting approved, and that could be 3 to 4 years away. So we skip to the next slide. We can look at the marketed compounds, and this is not an exhaustive list by any stretch of the imagination. But once again, you can see a lot of them are biologics. There are 2 small molecule drugs in here. Big change, as I said, from 10, and certainly from 20 years ago. And on the slide that follows, 62, we can just see the compounds and the types of revenues that they generate. Certainly is no Amgen, which can generate many billions of dollars from each of its drugs, but it has a lot of blockbusters. Amgen's an exceptional company in that pretty much every drug that it launches becomes a blockbuster. A blockbuster will be defined as having sales globally of $1 billion a year or more. And there are plenty of blockbusters in this list. BMS has its slew of drugs that just generate healthy revenues of a couple $100 million, but not blockbusters. So finally, I think, oh, yes, I just wanted to talk about the recent bad news. It had a phase 3 trial that failed in August. It was a drug that it licensed in from a small company, and it was for non-small cell lung cancer, which is a very hot area. Lung cancer is a horrible thing to get, and for most people, the outcome is not that positive. Most people will die if they have lung cancer, although great progress has been made. Merck has a competing drug in the market, so their stock price soared, or at least soared as high as a large cap company can. But Bristol-Myers Squibb got hit, and the stock price went down by 10% and has been flailing around since then. So for me, at least, this is a good opportunity to buy. And the fact that the pipeline, so future revenue, won't happen for a few years probably means that the stock price could remain depressed for a while. We're talking maybe a few years. It depends when analysts decide that maybe this is a company that they should think about for the long term. The long term then might be as long as a year, so they might jump on it. But the company will bounce back. It's a healthy company. It has a very healthy balance sheet. It has a very strong pipeline. It has excellent partnerships with small companies that increasingly do most of the research and development for pharma nowadays. It's just overall a good, solid pharmaceutical company. And for that reason, I think on the next slide, I'm picking Bristol-Myers Squibb, ticker symbol BMY. So
Thanks, Hugh. Well, thank you. We'll go ahead and add that to the tracking portfolio. And Ken, are you ready to run an audience poll?
I think so, Mark. Here it comes. Let's launch it. There we go.
Something that we often forget to do is to, even if you are new here, there's no, we don't know who you are or how, you know, where you come from or whatever, you are invited to vote. Especially if you like cruise ships. No, just kidding.
I apologize for I apologize for the equals in Bristol-Myers. That's just my own fat fingers doing that. So we encourage you to vote. We're up to about 70% of our audience voting. We'd like to get 85 or 90% if we could. So just take your mouse and press something. Up to 82% voting now, 83%. I'm going to kind of count to 10 backwards in my head, and then we'll shut this down right here. And I'm going to close the poll. And I'm going to share the results. There are the results. Those percentages are 52% for Novo Nordisk, 37% for Medmax, 6% for Norwegian Cruise Line, and 4% for Bristol-Myers. 1%, which is probably a single person, has decided that none of the above should be added to this portfolio. So we're going to, for the second month in a row, we're going to add a position in Novo Nordisk as well as an audience position in Novo Nordisk. So
it's a lot of pressure, Kim.
Yeah, it better do well, Kim.
I have big, broad shoulders. I'm fine.
So
she can take it.
I can
Mark,
take it.
I'm going to hide the polls now, and I'm going to pull up the question box and see what kind of questions we can deal with here.
Okay, while you're doing that and taking a look at the inquiries that we have, here are some of the coming attractions. Just FYI, it's not an all-inclusive list, but it is some of the highlights. We will do this a month from now on the final Tuesday of October. I'm virtually certain we'll all have small companies after combing the jungle for the small companies for the November feature of the newsletter. And Ken and I will be in Cincinnati, actually Dayton, kind of halfway in between the two, on Saturday, October 29th, and we will be out in Peoria for the Heart of Illinois chapter on November 12th. There's also, just short of Thanksgiving, a Mid-Michigan Stock Pickers Breakfast in Bay City, and we have a lot of fun with that one. I believe that's, what, the 12th annual, Ken?
At the 12th annual, right, and we're on the third Saturday in November up at the Doubletree Hotel in Bay City. Come on up, have breakfast with us, and Mark and I will try our best to keep you entertained for 3 or 4 hours. It's always a really good session,
The last time I looked, I was pretty near the top of the leaderboard, so there will be a party that day.
Yeah, we're checking the weather, Mark, because we do believe that hell is freezing over. So,
tough.
I think at the last breakfast, that's when we said that you would do well in one of our contests when that happened. So, and you are doing well in this contest. So we congratulate you. And like I said, we're checking the weather right now. Kim, I have a question for you from Christopher. He says, if everything is so positive for NVO, and it certainly looks impressive, why do you think the stock price has dropped so significantly since the Value Line report? Does the market know something that Value Line doesn't?
I don't personally believe so. I just think because of the presidential election and because you've heard that the pricing power and what happened with Mylan and the EpiPen, I think truthfully, I really just think a lot of the pharmaceutical stocks are getting thrown out in the bathwater. And that's a benefit for you and I because we're going to make more money. That's all.
Kim, you also have a question from William. He wants to know, do you know if one Novo Nordisk ADR is equal to one share of Novo Nordisk?
It is.
Thank you. We're getting a note from Marty from the OKI chapter, and Mark, he's correcting our location. He's saying that is still in the Cincinnati area on October 29th, and I think that if we've looked before, it's right near where the outer belt crosses I-75. And Marty, if I'm telling tales that are wrong, you can correct me, but it is closer to Cincinnati than it is to Dayton.
There, I fixed it.
Okay, Joe. Kim, Joe would like to know if you know why the Value Line projections have flattened for Novo Nordisk.
I believe that they say in the next year it'll be flattened with how the market is because of the election, and they're building that brand new plant in Denmark. And then it's going to be going up because one of the other things is Express Scripts has chosen not to approve one of Novo Nordisk's drugs. And this has happened in the past, and ultimately they do more testing and prove that one drug would be better than their competitors, and then it is approved. But currently there is, I can't remember which one it is, has not been approved by Express Scripts to be in their system to be as being number one.
Thanks, Kim. Phil has a question about Mednax. He said it was doing phenomenal up to July, but has since plummeted. I haven't seen any reason. Phil, I think you need to get the value line sheet and read through it, and also get the S&P report if you can. Read both of those things. You'll get a little bit of insight into some of the short-term challenges for Mednax. And I think I mentioned at the beginning of the presentation that the last 2 quarters in earnings have been fairly flat, and that was not met by the market with great enthusiasm when the company reported earnings that were fairly flat. I did report that this is not unusual for this company, that if you get a long list of quarterly material and take a look at it, you'll see that this happens on a fairly regular basis, where it'll come out with 1, maybe even 2, occasionally 3 flat quarters, but then we'll assume its growth again with, assume its growth on trend. So I would suggest you get a hold of a value line report and an S&P report. There is no report from Mednax from Morningstar, no analyst report. But if you read from S&P and from Value Line, I think you get a good exposure to what the near-term challenges happen to be. Kim, back to you. Go on. Was that Mark? Go on, Mark.
This is Mark. I was just going to make a point that this company is an acquiring company. They grow geographically by acquiring companies and bolting them on. And a company that does that is often subject to some disruptions and call them speed bumps. Anytime that the analyst or institutional investing community gets kind of skittish about that every once in a while, and that can explain a fairly short-term disruption in the stock price of a company like Mednax.
Right, and don't think of Mednax as acquiring a building or a manufacturing facility. Rather, think of them as acquiring a group of physicians which they bring under their umbrella, and then which those physicians sell their services through Mednax, and they sell them nationwide. But they're not buying a lot of brick and mortar, but they're buying partnerships, if that helps a little bit in kind of visualizing what's going on. Kim, Janine says, here's a historical question for NVO. How much of its future funding is going to be paid by cost cutting? Are they going to have to do a lot of cost cutting going into the future that you know of?
I don't believe so, because they're a cash cow. They generate enough cash to grow internally without taking on a lot of debt and paying out a dividend to shareholders.
Thank you. Marty Eckerly from the OKI chapter, that's the Cincinnati group, says that their event is going to be on the 29th of October, and the location is 3 exits north of I-275. That's the Beltway, just off of I-75. So it is much closer to Cincinnati than it is to Dayton. And Marty says, go to the OKI website if you want specific instructions, or if you'd like to register for the event. Mark and I will be there, and I will tell you that if it's anything like our Saturday in Indianapolis, we're going to have a really good time, and the participants are going to have a really good session as well. We had an exceptional day in Indianapolis last Saturday, and I just want to publicly thank, if any of you are out there in the audience, I just want to thank you for providing the hospitality. We just really, really enjoyed ourselves. We're getting a note from Sharon Lindquist Skelly, and I assume Sharon's from the OKI chapter as well. And she says, would you note that the Cincinnati event is free? So this is a free event there in Cincinnati, so that that should go a long way to making up a few people's minds on this list. I know we have some very frugal customers on this list all the time, so it's a free event. All you have to do is get there, okay? Mark, I've cleared the question box. I'm just looking up near the top to make sure. Don would like to know, Mark, this is for you. He says, I know this is a roundtable webinar, but are you going to run a TSP webinar in Manifest anytime soon, Mark?
Soon, I would say between now and the end of the year. I've got some stuff to take care of, including Mr. Holbert, but between, I would target sometime around Thanksgiving, perhaps.
Okay. Sharon is saying, where do we see these recordings? And Sharon, there's one of the easiest place to see them is to go to the Manifest Investing website, obviously. But in order to see these recordings on Manifest, you need to be a subscriber, and we'd like you to at least consider that. But if you're not a subscriber, we put all these recordings on a YouTube channel also, and it's called Manifest Roundtable. And there's there is a space between the word round and the word table. So if you go to that YouTube channel, Manifest Round Table, you will see recordings of almost all of the sessions that we've done, especially in the last 4 or 5 years. And we try to get them up there as quickly as we possibly can, but please remember that I'm a volunteer, and I get to things sometimes when I have the time away from family to get it done. So we're glad that you're interested, and we'll try our best to get those recordings up there as quickly as we possibly can. Mark, we're getting a lot of interest on a class on wizards at BINC this coming May. So,
we got to make that happen.
We might have to bring the wizard game with us and offer a free class in the evening for anybody willing to learn how to play wizards at BINC, okay?
Hey, that's what they do at the Motley Fool. Nice gaming night. Hey, here's something that we learned in Indianapolis that I think you guys will find most interesting. Those of you that are familiar with the changes that have happened recently at Yahoo Finance and how they've kind of moved stuff around, and it's been kind of disruptive, and a lot of us are stuck in our old ways and prefer the things the way that they used to be. Mary Becker and Roger Browse convinced us that all you got to do is put a CA in front of it, and the Canadian Finance Yahoo site is unchanged. If you go to that, it's the same as ever. And for example, Novo Nordisk, as always, the ticker symbol used to be right up here. You look it up. There's your old format. If you want to look at analyst estimates, it looks exactly the same as it always has. Have no idea how long it's going to stay that way, but again, all you have to do is switch to the Canadian Yahoo Finance. And I know some of us have been in some agony trying to find information on Yahoo. They're getting better. We'll give them the benefit of a doubt as they really do seek to improve the site, but that disruption can be at least managed a little bit with Again,
in the URL, it's just put CA dot in front of the word finance. Mark's highlighted it up there. Put CA dot in front of finance.yahoo.com, and you'll go to the Canadian site. We also notice that it operates faster, doesn't it, Mark? Or it seems to operate a lot faster.
Probably a lot less traffic, and if you want to go and read headlines on Novo, here you go. And just look at how much faster it runs than the other site. Let's hope that they continue to make improvements and things get better, but I wouldn't mind if they forgot about improving the Canadian site for a while to come.
Mark, we're getting a note from Carla. Carla, I do have your note about Mark and I coming to Minnesota. I will try to give you an email or a phone call in the next 3 or 4 days, but we have been doing an awful lot of traveling. We'll try to get with you in person and talk to you about a possible date and some possible appearances. Thanks a lot, folks. We really appreciate you attending. Mark, I've cleared the questions. Hugh, a great big thank you to you as usual. Tim, you're a lifesaver when Cy is traveling. Thank you so much for putting in the time to prepare the presentation. We really appreciate everything you're doing for the roundtable. Mark, as usual, I couldn't do this all alone, and I just can't thank you enough for your help on this thing that we do here. So with that being said, if there's nothing else from the rest of the Knights or the Damsels, I'm going to say good night to everybody and close everything down. Mark, you got any last comments?
Thanks, Ken, and we look forward to seeing you guys as we roam around the countryside.